We're snorting cap rates and shooting up cash flow here at Deal Junkies. Welcome back to Deal Junkies. Here in the studio today with none other than Trevor Howard and Mike Nuss. I'm Gabe Johansson. Dane is gone. It's Black Friday. Happy Black Friday. Did you guys have a good Thanksgiving?
I can't get past thinking about people jumping out of buildings and how good of an analogy that is to explain market cycles.
Oh, we're going to talk about market cycles today.
Yeah, but I had a great Thanksgiving.
All right, good. Did you eat too much?
No, everything was vegan. Went to my parents' house.
Oh, vegan. A vegan turkey?
My 18-year-old's vegan.
Wow.
We don't, my mom doesn't cook turkey.
Oh, okay.
Yeah, that goes any...
So what do you eat for Thanksgiving? Like salad or?
All the everything except turkey.
Oh, everything.
We have ham.
Mashed potatoes. What kind of butter do you put on the
We did not have
potatoes?
stovetop stuffing. It was a little... like, because most stuffing has broth in it.
Yeah.
And...
Well, you can do vegetable broth.
Sure, but that's not what corporate America does. So the vegan version tastes a little different. Yeah. So butter was real, ham was real.
I was vegan for 2 months one time.
I was too.
I almost died. I didn't have enough B12, and I was actually I had to go to the doctor, and I was getting really sick. Yeah.
I did a 30-day vegan challenge, ended up going 60 days, and that's when I became a trail runner. I was a felty, sexy human being.
You should do that again.
I will.
All right. Starting today.
Yeah. Should we talk about people jumping out of buildings now?
Yeah, give us a frame of reference. Why were you talking about people jumping out of buildings?
Okay, so we're going to talk about market cycles. And before we got into this, I said, why do we just frame that the start of the cycle is at the bottom?
Oh.
And Trevor's like, yeah, you can frame it's a cycle. You can start it anywhere. You can frame it at the top. And so then we talked about, well, if we frame it at the top, go back to the Roaring 20s, 1929.
Like that was the top. That was the first inning.
Yeah, so you have the top, and then the top creates hyper supply, and the hyper supply.
Wait, don't give away all the answers. I want to quiz Trevor and see if he knows what a market cycle is.
Let's quiz him.
Trevor, what's a market cycle?
I'm assuming the definition is just prices being up versus down and how it repeats over time.
Oh, my God.
Wow. That's the least robotic answer you've ever given, I think.
It is the...
You don't like that answer?
What are the stages? Do you know how many stages there are in a typical cycle?
4.
What are the names of those stages?
Couldn't tell you.
You want me to read it?
There's the recovery. That's the start.
Well, okay.
I mean, so if you think about
if
your graph, you're increasing, you're peaking, you're decreasing, you're hitting the bottom. Mm-hmm. Like, is that your 4 stages?
Well, and that's what they do. They show the 4 quadrants, and then they show a line that goes up and down.
I think we should preface this with, why does it matter?
Okay, well, we'll get there. But here's the 4 cycles, or the 4 phases of a cycle: recovery, expansion, hypersupply, recession. And then it rinses and repeats. A lot of investors call this like baseball innings, which I'm not really sure because there's more than 4 innings in a baseball game. But apparently in the beginning...
2.5 innings per cycle.
Well, I guess if you broke each of those 4... Yeah,
2.3 innings per cycle.
So are we in the first or second inning? Are we in the third or fourth inning? So the reason why I wanted to talk about this is just so I can fully understand where we're at in the market cycle. And then Mike and I were talking, it's a lot different between commercial and residential. It's different in different areas. But a lot of folks are saying in our space, in multifamily right now, that we're at the top of the first inning, which sounds exciting.
When Mike talks about investing in me, he's always talking about bases and not being able to get past the first one or something.
Bases?
Basis.
No, basis.
Cost basis.
Like first base, second base, third base.
No.
It's every morning when I see him, he says he was doing something about bases.
He couldn't get to third base.
Something like that,
One thing anyone needs to learn from this is basis, cost basis has nothing to do with baseball.
Which cost basis are you on today, Mike? Okay. So where are we at? Are we in the first inning?
No, we are right past the Roaring 20s.
The Roaring 20s.
So I want to use
the 1920s?
Yeah, the 1920s.
Oh, where people start jumping out of buildings?
Yeah, and this is a really good example because what we need to understand is everything about our economy is based on perception. And the reason that we have cycles is because our perceptions change of where we are in the cycle based on how we feel and our experiences in life. And so if you're in the Roaring 20s, we are not creating hyper supply. Like from the stock market level, That's just perception of value in the stock market, and everyone feels good. There isn't a hyper supply. There was an immediate release of demand, right? So when we'll talk about supply levels and how this happens in a cycle, but supply isn't just based on inventory. Supply is based on the demand for that
to match
inventory.
up to the inventory. Yeah.
Exactly. So the stock market crashed because the demand for those stock prices just crashed, which then led to people jumping out of the window. So that is the example of hyper supply being created almost overnight
because of the immediate drop in demand.
Okay. Correct.
Okay.
And then and then parlay that into, well, that demand comes from money, from purchasing power, from perception of value, from debt, from liquidity, from equity, right? And so all of that then forms into these waves of cycles.
When we're talking about a market cycle, are we talking about the U.S. economy? Are we talking about real estate? Are we talking about stocks? Are we talking about everything? Like what specifically are we talking about here?
That's why we can't communicate, because we all talk about different cycles.
Stuff?
Yeah, because there's this major cycle, but every industry has its own cycle.
Sub-cycles.
Yeah, because there's a long-term debt cycle, which is where Ray Dalio's so good at this. So there's just a macro long-term debt cycle, and then there's short-term debt cycles inside of that long-term debt cycle. And then every single industry in our economy has its own short-term and long-term debt cycle, if you compartmentalize it and think of it like that.
So Warren Buffett says everything runs in an 8-year cycle. I mean, I'm not as smart as Warren Buffett. I think that sounds about right. Do you guys agree with that?
Why does it have to cycle?
Well, I think the way it was always taught to me was that this is rigged, that it's set up on purpose so that they can drive asset values up and down so that we can transfer wealth from the bottom to the top. But I don't know. That could be a conspiracy, but it sounds pretty accurate to me.
I love when he hangs out with Paul.
He's the sensei.
Yeah.
So.
Spending, we have cycles because spending drives everything. Our emotions drive our spending. How we feel dictates what we spend in, which then dictates industry cycles, which then feeds into the
So explain the cycles a little better, because you're talking about all the different market cycles. So we have the real estate cycle, and you have...
You want me to read it to you? Okay. So in the first stage of recovery, which is often considered the first through third inning, the market bottoms out, demand slowly returns. There's still a lot of vacancy. There's great opportunities at this point.
So this is on the graph. This is coming back up.
This is like we've hit the bottom and now we're ready to go.
Back up.
This is where you want to get your name on deals. Like how we would look at it. Expansion phase is 4th through 6th inning is strong growth. You get your rents start to go back up again. Confidence, like Mike's talking about, goes up. Your new construction starts to ramp up again.
In this cycle, are we starting from peak going down to the trough and then back to peak, or are we starting at peak and ending at trough?
The first inning would start just as you bottom out, and you're coming back up again.
And it's called the trough in real estate. In the real estate books I read, it was called the trough.
Okay. So this is where you make your money. So we get all our name on the deals now, and then when we get into the 4th through 6th inning, that's where we see the value of our deals go up, and we make a lot of profit.
At that point, or
that's expansion.
It's on the way up.
It's on the way up.
So is your whole cycle from bottom to top? That's one cycle, or is it bottom to top, back to bottom?
So bottom to top. Well, no, hold on. Go ahead, Mike.
Really good question. Why do we have cycles? The main reason we have cycles is because the length to produce inventory is longer than the shift in demand.
Yeah, so it takes longer to build than to buy.
Exactly. And so you have a trough. We're getting into expansion. Okay, now economic conditions say we can go build something.
But the trough is due to interest rates, not necessarily supply at
in
that
commercial.
Point.
All of that. But let me finish, right? So we're in the expansion. Okay, now we go build, right? But by the time we're done building, are we still in the expansion, or has expansion stopped and now we're getting into hyper supply?
And I think, to your point, that's what happened when we got into hyper supply. It was from a lack of demand.
Correct.
Not because we overbuilt.
Yeah. And so look at Portland as the best example. Is our migration rate went from one of the tops in the nation coming in
migration number 1, 2, and 3 for 5 years.
Forever.
And now it's way down the list.
Yeah, we dropped from the number 1 in the nation to like the 50th or 80th in the nation. It was ridiculous. And
There's only 50 states.
Yeah, so we had to reproject our population growth.
We're 80th out of 50.
And that's what demographics is born off of. Demographics is born based off your migration patterns, where you live in the inventory and resources you have for the people living there. We didn't have enough housing inventory when we were leading the nation in migration. But when we no longer lead the nation in migration, we have plenty of housing inventory.
What causes the in-migration? To me, it's everyone talks about quality of life and these things, but it's all money. Like it's
cost of living is a huge
It's cost
driver.
of living. How much money can I make? Where are the jobs? It really is economic. I mean, people will look at that secondary, it's a secondary decision, like, oh, I get to live in a clean place, or they have the restaurants I like, or whatever. But ultimately, you move to where you can make the most money and it costs you the least amount of money to live.
Yep, and get the lifestyle and environment that you want to live in.
So when Portland was number one on the list, what was driving that? We had huge, was this Intel and Nike and all these big companies were hiring, and there was just a lot of opportunity in Portland at that time?
Yeah, tech startups was a lot of it. So it's a lot of small businesses, small startups, venture capital, Morley, and then it's the shoe apparel industry, the shoe and apparel industry, the branding industry, the food and wine and the marijuana industry, the entertainment industry. All those things go hand in hand. And as those tech startups and the salaries increase, and so what you look at, like from a demographic standpoint, is household income. And so we break that into buckets, right? So household income under 40 grand, 40 to 80, 80 to 120, and 120 and above. And our household incomes in those top two brackets, 120 to 200 and 200 and above, I think of what it was, had the most growth. And so now our purchasing power used to reside in that 40 to 80 world. Now our purchasing power resides in that 80 to 150 world. So now immediately your demand and your effective purchasing power is significantly greater. And so if you don't outproduce that demand with inventory, now you have a shortage of supply, and then those prices go up.
Yeah, because your tech jobs are paying 3, 4, 5 times as much as the average wage.
Yeah, and so that's why I say where housing is filtered through income, right? Like the people who have the most purchasing power get the most opportunities to buy what they want. And so then the people with the least purchasing power gets what's left over from the people after they choose and operate and buy what they want.
So you're thinking of this very much from a residential mindset of just the average everyday Oregonian getting a job, coming here and trying to live life and bringing more income into the state, change the whole.
Correct.
So then obviously something has changed if we drop to last place or whatever it is.
Yeah. So now you look at it from a business standpoint. As a business owner, it was really good to locate your business here because housing was cheap. You're close to everything in nature. We're great for remote employees. We can create these types of incomes. But then, the cost of housing gets more and the cost of food gets more. And then they create this tax, and then we decriminalize drugs. And so then we create these policies where now it's really hard to operate as a business owner. And so then you don't want to have your business here. And so now you want to look for better ways to relocate your business. And so now that changes in economic time.
It's one of the least business friendly
But aren't you talking about all the different factors that change the cycle? So you're just like, things happen affecting the market, but it's an unpredictable way still?
No, it's very predictable if you can see the spending patterns and understand what creates those spending patterns.
I don't think it's predictable because,
how do you define predictability? On a day-to-day basis, it's impossible to predict. Are you defining it on a day-to basis, 30-day basis, quarterly basis, semi-annual, annual? If you look at it from a cycle standpoint, you can see where we are at in the cycle. It's very easy
nationally, I think you have more data nationally. It's easier to see.
When you're saying cycle, you're saying there's multiple cycles. What cycle are you talking about? Like home price cycle?
You can shift and look and see different types of cycles. So this is a good question, good way to contrast. So what we saw in 2022 is so what are the 4 cycles again? There's the recession. So we saw a recession before we saw hyper supply. And the recession came because of interest rates, because the cost of housing jumped significantly, which then created a sales recession. and the cost factor created a value recession immediately. Then once the values came down and once the cost went out for longer, that then built up supply.
But there was so there was distress in transactions, but there wasn't necessarily distress in residential real estate because the values stayed. But
Correct.
then there were no. Well, did they? Because nobody was selling, so we wouldn't even have known because there weren't enough transactions.
Values came down, but it's the value from December in our area. The value created from December 21 to May 2022 came down from May 22 to November 22.
So it was a bubble.
It was a quick little bubble.
Yeah.
And that is the mortgage rate lockdown effect, which then changes the cycle for residential, or how the cycle plays out because of purchasing power, because of demand.
So the argument is that we could be in different cycles from a national level economy, like the global level, versus where we're at locally, and then break that down into residential, breaking into commercial, stocks, bonds, whatever it is that you're talking about. So overall, we consider, this is what I will say, in 3.5 years, I will just tell you, if you were to ask me where we were at in the last 3.5, I'd tell you we were in recession. I live in the commercial space, own a brokerage, property management company. Like, in the world we live in, it felt like a recession. Mm-hmm. But you look at the GDP numbers, you look at all the data that comes out, nobody ever said we were in a recession.
Yeah, Jay Scott made a comment on one of my posts recently.
Congratulations.
I love it.
First comment on a post.
He's your hero, right?
He comments quite a bit. I'm always.
We got to have him on the podcast.
We will.
I comment on your post too.
Yeah, but you say stupid shit. So I'm sorry, I didn't mean that. He tried to say a joke. He's like, the problem is dollars get stacked upon each other, and the more that you stack them, the dollars at the bottom get more pressure on them, and they get least use. So you get a less yield, less value.
What do you mean by stack them on? Like
you print money, right? So now we've printed so much money that our cycles are inverse of the macro economic cycle.
So you think of a pile of money.
Yeah.
The money at the top is what? Easier?
Yeah, it's the newer printed money, and it makes the lower money harder to get a value from. But think of it this way.
Why is that?
So the money that we're printing now is money that is expecting a lower rate of return because it's printed post, whereas the money that was printed 30 years ago was printed exactly, right? And so you have
mean
to
just because it's deflation, because there's just too many dollars now?
No, because yields were significantly higher 30 years ago. And that's what our cycles, these are defined in textbooks from 100 plus years ago. Mm-hmm. Before we had a decade of yields came down by a rate, yields came down by a rate, yields came down by a rate, yields came down by a rate. That is money getting stacked on top of money, stacked on top of money. It started in the private world when we got off gold and we created all the private bond markets. That was just fake money. Debt created more debt, and we have these variations of debt compartmentalized into debt to monetize debt. And then after 2008, we started doing that at the government level. And so now we have 50 years of private debt stacking on top of 17 years of government debt stacking. And what we saw was a byproduct of now money has to work harder to get a yield.
Yeah.
So you guys are talking about how all this stuff is very volatile. It goes up, it goes down. So when I think about this stuff, like housing prices or real estate prices, for example, yes, it cycles, but it's cycling in an increasing manner over time because our dollars become worth less. And at every time period in there, you don't know how long it's going to be, or the trough in the valley and what the altitude differences between those is going to be. So it's like it's useless.
And your brain is working on long timelines because you're in the commercial space, whereas Mike's brain works on shorter timelines in the residential space.
My brain is seeing difference. So what I've seen is what I've said is historically our down markets are flat markets. That is exactly what you're pointing to, is our values don't go down, but because of inflation, we go flat. But over time, that flatness increases. Mm-hmm. That's what you're saying. And because we've printed so much money and now it's so much harder for money to get a return, that changes because our asset, the byproduct of that is low interest rates in order to feed that low yield, which then puts asset values up, which then creates these bubbles. Mm-hmm. We didn't see a real estate bubble prior to 2008. We saw another one 14 years later, right? I've been in real estate for 30 years. saw one real estate bubble. And then the second one...
Wasn't there a real estate bubble in 19... when was the one before 2008?
So the 1980s was not a real estate bubble. That was values were relatively flat over that period of time.
Okay.
Interest rates were going crazy and transaction volume was crazy. And that's where owner financing we didn't have a banking system then, so it didn't affect values the way that it did in 2008. Right. And so this conversation that we had and why commercial is different from residential is how many people sell their home because they have a maturity date coming up?
None.
But in 2008, that was the world that we created where people started selling homes because they were in a bad loan product, and the loan product forced the economic decision, where historically real estate is based on life decisions, not economic decisions from a shelter component, whereas commercial is based on economic decisions and financial decisions.
And your loans term out.
Turn out, which forces those cycles, right? So that's the debt cycle, and that's our lenders forcing our cycles.
I come back to this point every single time.
What can you use this information for?
What can you use this information
We're
for?
We're not done talking about cycles. So once we get past expansion, we're in hyper supply, and this is what I wanted to learn out of this podcast. I already learned it. I've been saying that we had oversupply. We got overbuilt. But what Mike is teaching me is we had under demand.
Yes.
So
there's a difference between overbuilt and under demand.
So you remember how we were talking prior to 3.5 years ago? We were talking about how underbuilt Oregon was. We're like one of the most underbuilt states, maybe number one, I think HUD says, out of all 50 states.
I think how they measure that is off because people are seeing high vacancy rates in their apartments.
That's what Mike's telling us right now. Is if you look at the demand trend, if it were to stay continually going up, we're underbuilt. But we saw a big drop in demand over the last 3.5 years, which created the vacancy. So we thought prior to going into this downturn, we thought we can never overbuild. There's no way to overbuild, but there is a way to overbuild if the trend line for demand drops suddenly. And it drops suddenly. And then the question is why? Why did it drop? Less people moving to Oregon, less income. Obviously, people on Main Street, they're getting hit in the wallet. Even though everyone's telling us we're not in a recession, I think most people on the street, when you look at consumer confidence, I never understood like what that meant. Like you call a bunch of people and ask them if they feel confident or not. Like you're saying, this does matter because we vote with our dollars. I mean, we're technically driving the market based on how we feel.
And it's not even that. One man's spending is another person's income, right? One person's spending is income. You don't get income without spending.
So the dollars stop moving.
Exactly. And so you have to look, if you can look at the world through a lens of spending, and then if you understand it's our own best interests and our own psychological decisions that then force that spending. And then if you look at, okay, well, what is the typical makeup of how someone spends? So like the people, the fucking baby boomers are like, you don't use credit to, well, you grew up in a world where you didn't need to get a car loan to have transportation. You didn't need to get a house loan to be able to have a house, right? And so the barriers of entry to own your transportation, to own your house, to save money, to invest money, to have all the clothes that you need, to have all the food that you need, to still enjoy life. Sure, all the technology is there, but the way to achieve that is through credit because the value and the cost of everything is significantly higher than the income we make.
So do you think the cost is higher or we just have a higher standard of living? So
the dollars are just worth less.
Well, no, but we're also paying for nicer things and we have higher expectations.
That is part of it.
So people used to go on vacation to a national park and drive 8 hours.
Now we got to go travel the world
we go to
and
Tokyo and all these things.
Or walking around with a $1,200 phone in your pocket. I mean, even the people at the bottom are living technically at a higher quality of life, or at least from a money perspective, a higher quality of life than we were before.
Yeah, and that's just those cycles driving it.
So, Mike, do you think you can predict the cycles?
I think it's really easy to understand where you're at in the cycle. And when you understand that there are different cycles that react, it's very easy to see it. Let me point the picture to Portland. So a development cycle is different than an income producing cycle. So our development cycle created a significant amount of inventory it all got absorbed, though. That would have caught up to the demand that we had. But then demand got pulled back, which created this longer gap where the income cycle sucked. Concessions, just getting up to an occupancy. And as that income cycle sucked, guess what you do as a developer? You stop developing. And so as you're working your way through that income cycle and you get through that income cycle and then you absorb all that inventory, that development cycle is longer. And because that development cycle stopped, because that development cycle is no longer determined by profit, that development cycle is now determined by lenders and their desire to lend to us based on how they think we can be profitable. Now we get into a scenario where, we sucked up all of that supply. We've absorbed it. The demand has now increased a little bit because Portland's got a little bit better. Shit, we only permitted 200 units last year.
Yeah.
Because the development cycle is behind the income cycle. So now we switch cycles. And so now we go into an expansion because the amount of inventory compared to the amount of demand has flip-flopped again.
As long as the demand doesn't drop significantly.
Exactly. And so then you have to pay attention to then what feeds the demands. Intel layoffs are bad. Nike layoffs are bad. So then you compartmentalize that as, okay, well, where do the people that work at Intel live? Well, they live for the most part in Northwest Washington County. Where do the people at Nike live? Well, they do live in East Portland, right? And so then how did those layoffs affect the housing demand in those arenas? How does that affect business demand, labor rates, hiring, right? That's a lot of talent that just got released. And so all of this plays into things. So it's really easy to assume, well, this is just, you can't see it. You can pay attention to it. And here's the thing about data mining. So Jeff Hoffman, I got to have lunch with Jeff Hoffman for one day. He created Priceline.com. He created the kiosk, invented the kiosk where you check in at the airport. Crazy billionaire, one of the coolest billionaires I've ever met. What was
have you met multiple billionaires?
Yes, I have.
Who's the other ones?
Don Drysdale, a couple other guys.
Because there's only 1,000 billionaires in all of U.S.
God damn it! Where was I?
Mike's
Pardon my
met
French. Where was I?
You
going?
have to be the point, like 0.000 whatever percent that is. 1,000 divided by 400 million.
Where was I going? What was I ranting on?
Hoffman. You're talking about Hoffman.
Yeah, but what was I ranting on?
Priceline. Prediction. You were going to tell me how you can predict
the market.
Stuff. And then I was going to ignore what you said there. I was going to say, I still don't think you can because you're looking backwards to explain things. And if you could truly predict it, you would have way more money than you do right now because you could profit so heavily off that. I think you can kind of see their cycles, but you can't see the time frame. You can't see how big, how little. Like you can't predict in any significant way.
One thing I'll say is from 2008 until 2014, just in the Willamette Valley, rents were flat. I blame, they passed a law in July of 2014 that said that landlords could no longer discriminate against Section 8. So it used to be before that, you'd pull up Craigslist and it would just say no Section 8 tenants. Oregon says, nope, you can't do that. A lot of owners at that point said, well, I don't want Section 8. So they'd look up what the threshold was, what's the high water mark, and they just raise their rent above that so that Section 8 voucher holders would not go after those units. And really, the opposite effect oftentimes that happens with the government is they try to, the very person they're trying to protect, they end up hurting because a lot of the inventory, the rent started to take off at that point because now you put all the landlords on the same team, kind of, right? And so at that point, rents had been flat in that part of the cycle for 6 years. Right at that moment, rents started to take off, and rents really didn't stop until about the middle of 22 when we went into the credit crunch. So we had an 8-year run, which my mentor Brian taught. He always talked about run-ups. That's what this whole growth hyper expansion or whatever you want to call it. I guess it would be the expansion phase. He'd call that a run-up. And so we had a run-up for about 8 years, and then it took drastically higher interest rates in order to stop that run-up, essentially. Mm-hmm. So everybody thinks in terms of like, I want, it's like being a day trader. I want to think that I can outsmart the system and figure out when things are going to go up and when things are going to go down. I'm not smart enough to time these things. So it is interesting, like what you're saying, though, is rather than trying to predict where we're going, you can at least try to determine where we're at right now. That's what I'm trying to determine.
And where we're at's going to determine, and what got us here is going to determine where spending goes next. And I was at one of these conferences where they're trying to sell you on all these fucking guru shit, right? And there's this software that showed, is stock trading software that showed, It takes a lot. This is where I started learning about money. It takes a lot of time and cost to move a huge pile of money out of one thing and into another thing. Our job is to get ahead of the big spenders in the world. And it's that level of spending. And this goes to Jay's analogy, which is those troughs, right? Those cycles. So the trough, that's when the local developer is spending, right? So local developer, regional developer, institutional money, right? So local money comes in at the trough when the risk is the highest, where they have the smallest amount of buckets. It's easiest to move, the lowest cost. They can take on that risk. They get that risk. They prove that reward. Then regional money comes in at the beginning of the expansion.
Is that the top of the pile of money?
No, that's the bottom.
Bottom of the pile of money.
So that is the top, because that's the newest money. That's the smallest amount of money. That is the local money.
Because we see it because we're right here.
Exactly. We're the smaller people, right?
Okay.
So that's going in first. That's going in and getting a return. That's showing the reward. We get into the first phase of the expansion. Now regional money comes in. It's not as big of a pile, but there is cost to move it. There is risk that it needs to be. It can get a lower yield. So it waits to get into expansion, where now yields have gone down, right? So the biggest yields are at the trough. Now we're in the expansion. Yields have come down a little bit
because there's less risk.
Less risk. So now regional money starts coming in. That fuels the expansion. That lowers yields, which is lowering risk, which then brings in the institutional capital, which is the biggest bucket, has the most cost, has the most risk, is the hardest to move, and works on the timelines that looks beyond this cycle. So they can get in at the end of an expansion. They can go through the recession. And then they're into that next cycle. And so different piles of money look at different timelines. And that's why we have a yield curve. And that's why the macro piles of money, they invest everywhere in the yield curve. That is their diversification program. And so if you can understand why are we investing in certain areas of the yield curve, and why we get inverted yield curves, and then how certain parts of the yield curve act like different assets that are outside of our yield curve, is the bond yield curve, right? So now certain assets line up with certain yields in that yield curve.
So to put this in layman's terms, tell me if I'm correct in my thinking. Local money would chase like 6 cap inventory. Regional money might chase 5 cap inventory. Global money might chase 4 cap inventory. Yep. They're looking for safety. The lower the cap rate, theoretically, the safer that money is. And they're not looking for the higher yield. They're looking for the safer play, because the bigger that pool of money gets, the safer it has to be. They can't go out and gamble with it. And so if you're not out looking for 10 cap. You always wonder, like, why wouldn't you have a $10 billion fund and go chase 10 caps? You can't do that because you got to go find the safe money.
But that's because that's not their money, and then you're just trying to collect a big enough pool of money, and a little return on a really big pool of money is a lot of money. So that's
part of it, but it's how that. So you're talking about how that capital is formed. We're talking about once that capital is formed, why it moves, how it moves.
Yeah. So you'll like this. So Tether. You love crypto. Tether.
What's Tether? Tell us
I don't know. I was just listening to a podcast. So Tether is a stable coin. So they take
tied to the dollar or tied to what?
So they take in whatever your currency is and give you whatever conversion rate of Tether coins equal to this, right? So they're collecting all these dollars. They get enough dollars, and then they go and put that in some of the most stable assets, so like treasuries and different things. Yeah. Once they have those dollars, now they're collecting income, and those are liquid, so they can sell the treasuries at any point to go and collect your whatever you want back, right? But now they've collected like an insane amount of money that they're just collecting interest on for trading this coin for, and then they get to go reinvest that income stream.
I don't think this is a new idea. I think this is what banks have been doing all along.
It is. It's essentially that.
It's just a different way of pulling the capital. Here's a good way to relate it to like what we do. So we were talking about a debt fund, and you were talking to me, early payoffs, and we'll give people a little, like, I haven't thought this through. But as I started thinking it through, thanks to the questions that you're asking, is, I'm going to create a debt fund, but I have to have a pile of liquidity, right? And so this is a debt fund just sitting in a checking account that can be used as liquidity. So I don't want my balance to go below a certain point, because I need my balance at a certain level so I can get loans to continue my operation. And so when I set up a debt fund, some of it's just going to be sitting in cash.
So you're paying out returns on the money you need to use just to show liquidity.
You should put it on
Exactly,
money
right?
market.
So say there's a $2 million debt fund that I create. I can lend $1.5 million to that in my various projects at, say, 18%. Those projects can be successful. I can sit on $500,000 in cash. That's my liquidity, which is then allowing me to get loans, continue my operations. That's liquidity. So if one of the people that are invested in the fund wants some cash, now I can pay out that liquidity. I can go recruit more liquidity to replace it. And so that's how now when you have a pile of money, you diversify it in a certain way. Whereas prior to that, my way is just getting debt and putting it on properties and and compartmentalizing it instead of pooling it and giving me options. I'm compartmentalizing it and restricting me.
Mm-hmm. Then you just run the risk of, if too many people want their money at once, the same as a bank run, right?
Yeah.
Like, I mean, you have to put restrictions on
Correct.
how much people can take out and what the timelines are to do that, because you might have to raise more capital just to pay them out their shares.
Yeah.
Okay.
Why raise a debt fund between many different people versus just trying to partner with one person who has like $2 million?
I don't know. You know any people that want to just give you $2 million in debt for having
You just said you
projects?
knew multiple billionaires.
He doesn't
so,
know him well enough. He needs to get, that's why he's got to take
I've
him to
had lunch with Jeff Hoffman, but I paid money to be at that lunch, dude.
That's why he's a billionaire.
Yeah.
He charges you.
God, I wish I could remember what dude, the value of what he said. It's psychology. Economics is psychology.
So again, my question is, why is this useful? I don't think it's predictable enough to do anything with this information.
No, it is. Okay, so let me just paint another picture for you. Based on our cycle and what we've explained on Portland and how we've built up, and then the political decisions that we made, and then COVID, and then the homeless community, it was very clear there was going to be a huge bucket of money thrown at mental health. So I go and find a distressed asset that no longer works as a senior care facility because the funding, the demand that creates that perceived value, that creates that income stream, doesn't fund it the way it needs to be funded. But because of everything that's happened in this cycle, a new bucket of money is being formed. That new bucket of money is going to increase the income stream if we operate it in this way. We see that. We know the process to change one operation use to another operation use, which then triggers the release of that bucket of money into that property, which then creates a lot of value.
Yeah, I think it's easy to look at going backwards. But again, I think if you knew cycles so well, doing real estate is a waste of time, and you should just...
Stocks.
Yeah. Because like, there's no point in doing all this work in real estate
because
if
you don't
can predict
understand
a
human
cycle.
psychology. I would rather shoot myself than trade stocks all day.
You would
Like,
just,
I
you
would
would just
rather
have to
go
make
through the torture
You would
of
just
the
have
up-
to make one trade though. Like if you can understand a cycle well enough.
Who is going to give me $10 million to make one stock trade, whereas I can go raise $10 million to buy real estate? My value, my worth, my knowledge is focused in
You're
this
saying
arena.
there's all these cycles. So if you can see cycles well
dude,
enough,
I'm saying
you
people
can amplify
lend
your
you
money.
based on what you're worth. No one's going to lend me $10 million to go invest in the stock market, but someone's going to lend me $10 million to buy real estate because that's the track record. And our economy is based on where people lend it, not where people spend
you
it.
get to leverage so hard, and if there's that many cycles and you can predict all the points in the market cycle, you can profit from any single one of them based on how you can
What
trade.
if you were the ones pulling the strings on the market cycle, and you could decide when those different phases hit?
What? If I could decide when?
Let's pretend you're BlackRock for a minute.
Okay.
So like Mike is talking about, we got to get out ahead of the big players. What if you're the big player? You're not worried about getting out ahead of anybody.
Because you're swinging the market?
You swing the market.
Well, and what you're missing is like investing in the stock market is not investing in a cycle. It's investing in a company that is in the cycle. And so your investment isn't just based on the cycle or the industry. It's the company and how they're operating.
So I had a friend who did this, and he was convinced he could see the same thing in everything cycles and all these different things between the asset classes cycle and whatnot. So he would diversify his portfolio between all these companies and all these commodities and all these different things. And like, I really don't believe that you can, because if you could predict those things, there would be such higher leverage from doing it in a different way than buying assets like that.
Dude, I think you've just not listened to me for the past 3 fucking years, dude. All I've been doing is predicting selling windows and buying windows. All coming from cycles, all coming from macroeconomics, all coming from the understanding of how demand changes by our own. Like, that has been my fucking strategy for 3 years.
I think what you're saying, Mike, is that if he can do what he says he can do, then he should bet bigger.
Yeah, you would have way more money if you could truly predict it and you had true conviction that you could.
Because you're thinking, what I'm saying is that you can see cycles every single day. And what I'm saying is I'm choosing an asset class where you need to see cycles that are over 7 years and we are inside of them, not picking stocks every single day. And the CEO comes in and he's pissed one day, he fires the wrong fucking guy, they lose profitability and the stock goes down. That's not what I'm saying. I'm not a picker. I am a watcher of money. I see how the money flows and I put my money inside of where money is flowing. If I put my money wrongly inside of an area where money is no longer flowing, like middle fucking housing in Portland, I change my entire operation and get out of that as fast as I possibly can. Unfortunately, it's a recession, so it takes 3 years to get out of that shitty decision because of where we're at in the cycle. And while I'm getting out of that shitty position in the cycle, I'm putting myself in lots of really good positions for the next cycle. And I'm doing that because I understand, fuck, it changed overnight. We missed cycle phase 3. We went straight to phase 4. Now I'm fucked. Now I have to make some decisions.
So, I mean, doesn't that prove your point of you didn't see it?
I didn't see it. It's never changed in a downward way, the way that we saw it change from a monetary policy standpoint.
But like, that's the whole thing, is you can't predict the future.
They're all a little different. They all work on different timelines, and they all are manipulated,
correct.
I think.
But what you should not do is avoid risk.
Everything has risk.
You can't pretend that there are no cycles. We can all agree there are cycles. We always try to figure out. I think one mistake we talk about is like sometimes when you're in a run up, you might get psychologically drunk on the run up,
which is what we did,
and think it's never going to end. And then you may not see that it's going to end, and you may not prepare yourself properly for that.
And so here's how that looks out. So as we're ramping up our inventory for the longer middle housing projects versus the flip projects, is because there's so much demand and the expansion is so strong, and there's the flip market is the easiest market to get into, had the biggest pool of capital, had the biggest amateurs, and they're pushing up the prices of those flips. And so as you're looking at your opportunities, wow, that looks really risky. This one, although it's a longer time cycle, it can absorb more risk because there is more profitability into it. And so we chose to buy 15 of those projects and 5 of the instead of the others, right? And so now you're in the cycle, and it wasn't that was a bad play. It was that was a huge stack of chips, which now takes longer to develop, longer to sell, longer to move. We still made $1 million on that decision. We just didn't make $5 million in 2.5 years. We made $1 million in 5. That's fucked up. But it's still profitability, and it's still understanding, where are we in the development cycle? Where are we on the income cycle? What I was able to do is realize quickly in July of 2022, ahead of a lot of other people, to say, stop, no more of this. This is where we're going. And we actually recognized it in 2021. The only reason we bought our last project in March of 22 was because it had the fastest timeline based on what we just did, and we knew we could execute it quickly.
What you're doing just seems so complicated to me, because you're making all these bets and changing strategies so frequently. It seems really hard to make money at.
Well, okay, so understand the cycle. It is really easy to collect a basis right now to get really good deals on real estate that you're going to hold for the long inventory. It is harder to turn properties for a profit right now. You can still do it. It is just harder to do it.
Yeah.
What you're failing to recognize is the psychology of it. This is my lane. This is what I'm experienced to do. This is what my staff is hired to do. This is what my capital stacks are designed to do.
But you have so the thing I'm confused about is you have 5 different lanes you're talking about. You're talking about jumping between these different things, which is really complicated to me. Versus my thought is just okay, the dollar becomes worth less over time. So super simple strategy is hold real estate, on long-term
as long as possible
on long-term fixed rate debt and have it cash flow.
And you just told me that it's really hard to make income right now in real estate.
It is,
so
but you still can.
How do you make money?
Yeah, you can still find cash flowing properties, but
and how much cash flow are you buying and finding, and how is that changing your life?
Right now, the most significantly it ever has.
And how are you structured to make the decisions to do what you're doing, to have the opinion that you have?
So I think it's because we're doing one thing and mastering this one thing rather than trying to jump from thing to thing. So because we get specialized knowledge and we can figure out how to tweak these deals and operate them better and find them better from doing one thing, we have a unique skill set in it. Versus I think if you're trying to jump and be like, this asset class is going to be better, the learning curve on it is so long on all these things that you miss the cycle of what you're talking about before you even learn how to operate it better. Like, to me, it's just really hard to make money jumping between these things, and it's way easier to just do one thing over and over and over.
You just got to do a much higher volume of deals if you're going to try to make money.
About 1% of the real estate deals can someone make adequate now money and it function as a long-term hold. My structure is not built to focus on that.
Because you're trying to make more now money.
Yeah, and part of that is based on how I've been structured through past partnerships and how we chose to spend money, right?
But you could just syndicate it, right? And then you get the combination of those, because then you're making your now money on your fees and then your long-term.
Syndication's so simple, isn't it, Trevor?
I mean, it is in theory. People give you find a deal.
No, here's a really good example. This is what I was trying to get at with like Jay Scott's comment. Syndicators right now are purposefully sending out ads and representations with lower returns.
Because they don't want to scare investors off.
They don't want to scare investors off, right?
Except for Trevor. He posts 188% returns.
That was our last deal.
I can switch to syndication,
cool.
which I have done a track record of, because I have a track record. I think someone trying to just jump into that world right now is jumping into the world that's probably the hardest time to operate in that world, because we're right behind the cycle of ease, which means we're in the cycle of hard when it comes to getting private capital.
It's hard to raise capital. This is why it's a buyer's market.
Yeah.
Because it's hard. It's getting easier, but
right.
It's been hard to raise capital. It's been hard to get debt. It's been hard to do deals. And now there's pain and there's some blood in the water. And so now there are more deals available just from our own. If we weren't trying to time anything right now, like you said, it's affecting your life more now than it ever has, because you're able to find deals right now that you were never able to find before.
But it's also because I spent 7 years, right, learning these steps and going through the
you
process.
had good timing.
So why don't you just do it in the stock market? Why are you not in the stock market?
Because we don't understand stocks.
I don't understand stocks. Yeah, I'm doing one thing.
Yeah, but you can make so much more value in the stock market. You're wrong.
I can't.
You're so wrong focusing on this. It's so much faster. It's so much easier. If you know this so well, why are you not in the stock market?
Because I'm saying I don't know cycles. That's my whole point.
No, and that's what we're saying, is that cycles exist. The people that operate best in their industries are going to recognize those cycles better than other people that are not inside those industries. So I think we have a 2-year track record on this podcast of being pretty damn fucking accurate.
So like Paul tells us about all the cycles he's predicted, and he didn't even predict the cycle.
Well, he got drunk on the last run up.
So like that's one of the most experienced and biggest buyers, right? And he didn't even see it. And like if all people, and he's thinking about that all day long. And like he didn't even see it. So like I just think it's not useful to it's useful to some extent to understand, but I think you want to mitigate downside risk. And then speaking to hard or easy.
How do you mitigate downside risk?
Long-term fixed rate debt.
I think that the answer here is we're not trying to predict where the cycle is going. We're trying to identify where we are at in the cycle so that we can be a good investor in each phase, right? So we are going to transact differently during each phase of the cycle. Rather than trying to guess where it's going or how long it'll last, we need to make decisions based on where we're at.
So let's talk about that, because that's actually useful. So how does it change your decision-making factor depending on where you're at in the cycle? And I don't think it does. So I think you're still trying to do long-term fixed rate debt, because the cycle can change.
So in 2022, I had no desire to go portfolio assets. they're just so damn expensive.
Explain what that means.
Like just buying long-term hold assets in 2022. Like that just
didn't make sense.
It didn't make sense. The cost of them, the difficulty to get into them, the fact that you had to get a bank debt to compete in that market.
To bet on 3% money always
exactly.
Being there.
So that was, I am not going to do that. That is just a waste of effort versus we've been collecting assets when no one else will collect assets.
Yeah, you want to be greedy when everyone else is fearful.
I don't know. I still think that's wrong. I think if you're doing the one thing, it's so much more beneficial and your skill level compounds over time. And you're talking about hard or easy. And hard and easy is a relative scale.
Portfolioing assets is the most boring fucking thing to do in the world.
And that's why it's worth doing.
I think here's the difference in what you're talking about.
I want to I want to enjoy life.
I think that the difference in what you two are talking about is you don't want to buy something based on, I think I'm at the beginning of a cycle and it's going to go up in value because we're going to work through the cycle. In every deal we do, we want to see that in a vacuum, we can create value in that deal. It's not based on a cycle. The cycle may determine how hard we're able to push rents or how much vacancy we have or when we're able to sell or whatever. Our returns might be better. It might mean we have to hold a project longer. Like some of the deals that we're buying right now, we're getting deals that we couldn't get over the last 5 or 10 years. But depending on how long this part of the cycle rides out, we need to be prepared, like you're saying, with long-term debt to be able to get off. We don't know when we're going to get off of that deal.
And that is the byproduct of cycles, right? When you're at the top of the expansion, you're getting the less yield, you're getting the less return, you're getting the less ROI. That's just the byproduct of it.
So when I started in real estate, I thought a lot about this, and I realized I couldn't understand it. I couldn't predict it. So I looked at it. I was looking at the opportunity cost of what I could invest in with my money, right? I wanted to quit my job. I had this time frame. I was like, what is the fastest, most efficient way to do this that guarantees my success? So I was looking at stocks. I was looking at real estate. And why I ultimately came to real estate is because when I did the math on it and I could leverage into a deal and I could purchase this deal and the rents don't even go up and the value doesn't go up and it's just paid down with that leverage over 30 years, even if the property was worth the same amount in 30 years, it still made sense to me. Mm-hmm. And that was my downside risk of it. And that's why
that's the beauty of it. And that's, again, the size of the pocket. So getting in, that's exactly how we were, right? It's macro. What we controlled from a money standpoint was so small, we didn't need to see anything macro. Get this small amount of control into place. And then over a period of time, what you control is more. The assets is more. The people relying on you is more. Your yield has to be much more cognizant of risk. And if you're much more cognizant of risk, you're probably going to be changing the decisions that you've been making.
I feel like you don't, because you don't truly understand how risky it is to go into something new because you don't fully understand it. It's the learning curve of the shiny object of this thing's going to be easy and I'm going to make more money in it, and then you learn that everything's really hard.
Like having a proud dad moment right now.
I just think the risk of like the shiny object is seeing something new and thinking the opportunity is there, and then you just realize everything's actually pretty hard to do.
Like, so, okay.
And you
so
get the compounded return from doing it for longer.
Like, apply that to me. Feels like you feel like I'm doing a very risky thing. Like, how am I not doing the one thing? Like, let's talk about the restaurant.
Yeah, you're switching between asset classes because you see this thing, you're like, this is awesome, this new asset or whatever, this new business model, this new thing. And it's all the same. And where you get the returns is from compounding it over time. And you're not spending long enough time, I feel like, in one thing.
If you're bouncing around.
And that's where you completely miss the boat on like human psychology. I have no desire to own a restaurant and bar. That doesn't appeal to me at all. What does it require from me? I need to understand how to get a hold of a real estate owner. He got a hold of me. I need to understand a real estate negotiation. He essentially handed it to me. I need to be able to get a bank loan. Already getting a bank loan. I need to understand how to stack debt. I need to understand how to form that transaction so it can live out the life of a lease. I've done that. I need to understand how to negotiate a lease. I need to understand who those potential tenants are and where to find them. He's already brought those potential tenants to us. I need to understand the difference between a residential lease and a commercial lease. Triple net, gross modified. How to then negotiate those leases, and then how to structure that lease in a way so that the bank will give me a loan to then own that project, which then is triple net, which I don't have to put any money to. It doesn't take up any sleep. It is purely maybe 3 hours of my time to put an asset on the balance sheet that has good debt, fixed debt paid down over a period of time, ownership over a long period of time, paying off by a tenant that creates a little bit of cash flow that does not change my life.
Yeah, I don't mind that.
It fits your buy box.
Right.
But I think like my personal problem with what you do is you just try to do too many things because you get too bored with some of these things.
Dude, that is my...
And you get to choose. That's your life. You can choose to do whatever you want with it. I just think you would make more money from simplifying your life.
And here's the thing, and this is where economics is fallacy. Our purpose is not to extract as much profit as we can out of life. Our spending decisions show that. At a corporate level, that can be different, but at a personal level, if all we wanted to do was be wealthy, we would make significantly different spending decisions. If all we wanted to do was be healthy, we'd make significant different spending decisions. If all we wanted to do was have great relationships, we'd make significantly different spending decisions. But we are in our best self-interest for the most part of it, and you can look and see and estimate and guess and show how people are making those spending decisions. And then that just parlays
I think
into...
most people are making just poor decisions.
A lot of them are.
Well, what's a poor decision? I don't know. A guy who's happy with his 95 that gets drunk Friday and Saturday and has lots of friends and good relationships and is going to have 500 people show up at his funeral and he dies at 65. Why is that a bad decision?
Just his
Sounds
decision.
like great for him, right? Like we want to judge other people's decisions, and that's why we get into the fucking political wars that we're in.
Yeah, real estate is about people, and people are unique, and everybody wants something different out of life. Everybody wants something different out of their investments.
I think most people aren't doing what they wish, though.
I think if we should sit Warren Buffett in here in the room, he'd tell us all we were stupid, that we just should buy stocks and go buy them at a discount and hold on to them for a long time and live a long time, and we'll be really rich. I mean, but I don't understand how to value a business and how to see things that are on sale. I know how to see when real estate's on sale. And so I've been doing this long enough to where I know that right now is the best buying opportunity I've had in my investment career. And so how do we shift? What is the action that we take based on this part of the cycle we're in? I think we want to buy as much as we can, but we always want to buy as much as we can. But right now we want to ramp it up. We don't want to wait until we're in the expansion phase to be adding the bulk of our inventory. We want to add as much of it as we possibly can right now, partially because those deals...
You want to be building during the expansion phase.
But you are going to buy more real estate at the peak than you are right now because the amount you are buying is increasing exponentially.
Well, that's once again, that's a micro perspective of where I'm at in my cycle.
And that's a long-term vision. So he's saying at this peak, in this cycle, you're going to buy at the peak, but in the overall 4 or 5 cycles, it's not going to be at the peak. But that's just a byproduct of being in business over a longer period of time. But you still need to recognize the cycles so you can change. Like Michael Hamilton, great example. We went from expansion to fake hyper supply to recession. I'm not pulling any permits. That would be a really bad decision to pull permits. But now we're at the trough, and now we have a delayed development cycle. Now it makes a lot of sense to go break ground.
And we know that because we're boots on the ground in our market running our business. We know when it's the right decision to buy a deal. Well, most of the time we do. Yeah. And we're trying to buy the right deals, and we're putting all of our effort into that.
I think the cycle, yes, does matter because you're buying different deal types with different debt structures and different things. But ultimately, you're trying to do the same thing the whole time. Like Michael is trying to stack different deal types and measure that, but he's doing one thing.
You're doing that one thing and according to where money's being spent around you. Right? So like I can't go to Dallas and just know where all the money's moved and why it's moved and how it's moved over the past 30 years. I haven't been there. But if you want to talk about any part of town in Portland, I can tell you exactly the political decisions and the money stacks that were created, how they were created, the political movement behind it, and then how it was dispersed to affect these different communities in these different ways.
I think you can looking backwards, but not forward still.
Dude, how does spending in... Oh, my God.
Because so my whole point is if you could predict this well enough, I think you would have way more money than you do now because you're amplifying your... If you're saying I can predict
the money that we have now is based on the pile of money that we started with. I started with fucking nothing, dude.
I still think you would have more though. Like if you
What are you talking about? You know how an exponential graph works?
Yeah, it goes up really
all
fast.
that money is going to be made 10 years after my start, which is now, because I have all this knowledge and I've seen the cycles and I've seen how the money's moved and I can predict where the money's being moved to. And now I have the resources to put myself in a position to profit off that. 10, 15 years ago, I had no fucking clue how to position myself in front of money. But once I learned how money worked and once I saw cycles, it's like, oh, guess what? There's a whole bunch of institutional money being placed on apartments in Portland. Maybe I should go buy a bunch of fucking apartments and renovate them so I can charge $100 less than the new one, even though it's 120 years old and it costs me half of what it costs to build a new one.
So in that regard, do you have to be in front of the institutional investor, or do you actually just follow their lead?
You just, well, it's more advantageous to be in front of it, but you can follow their lead.
Because you start to see, we're seeing this down in Corvallis, where the institutional global big dogs are coming into Corvallis, and OSU is just, it's a hot college, and it's ranked and at the top of this special list and everything, and so they're in there buying up buildings and knocking them down and building towers and doing stuff. And it's just, this is new to Corvallis, and we got there ahead of them. But now that we see where they're at, it's like, oh, now we have, when you're talking about where the money is going, where's it coming from? And when you start to see players come to a little town like Corvallis that are global student housing players, it's like everybody, wakes up and goes, oh man, maybe what I have is worth more. Maybe I should own more of it.
You can take advantage of that because you know that asset type so well and you've been doing the same thing. But someone seeing that, they probably wouldn't see that, right? Because they're not in there.
They'd never even know.
And then you try to go jump into that. Let's say you do see it. Now you have all the other skills that have compounded over time that you can't take advantage of.
Yeah, but you should be worth more money if you're doing something different. It's we're just arguing about time frames and the compound effect.
My whole point is, I don't think it's useful enough information to hop around between different things.
You're saying if you stay in one lane, you'll be able to compound faster if you stay in that one lane, rather than like, oh, I compound a little bit here and I move over to this lane and now I compound a little bit.
Okay. So if you were me in July of 2022 and you had a $25 million affordable housing condo pipeline, would you have stayed in that lane?
I don't know anything about that. I just know, to me, it sounds like...
Just looking back, values compressed about 10 to 15% in that market segment. Absorption rate
I would have never done that originally.
Okay, so that's not the question. The question is, if you are in the middle of that development pipeline and the cycle changes, do you just double down on that because it's better and more efficient to stay in one lane?
You got into that because you're thinking you're predicting cycles and then you predicted it wrong and then it caused you problems versus I'm thinking I can't predict the cycle, so what decision can I make?
It's not predicting the cycle wrong. It was predicting the monetary policy wrong and the cost of money wrong.
Which moved cycles.
Which then changed it affected the cycle. It didn't change the cycle. It affected it. It drew it out is what it did. It was still profitable. It just was less profit per time. So it was still profitable. Do you think it would have been best for me to dump all my efforts into that one thing?
You're saying you made the wrong decision, correct?
No, I'm not. I'm saying I made a bet and that bet paid out less than what I thought it was going to pay out.
Yeah, so you would have rather done something else.
No, I'm saying I'm making a bet and it doesn't matter. Once you make a bet, that bet is made.
Yeah.
Sure, but would you have rather done something else than that?
It doesn't matter.
It does matter.
I was doing other things.
Here's my thought. Here's what I think.
What do you mean it doesn't matter?
Psychologically, here's why I don't buy Bitcoin. I've said this before, is I pretend like I own Bitcoin, and when Bitcoin goes way up, I say, oh, would I sell? Yeah, I would sell it because I'd take my profits off the table. When Bitcoin goes down, would I freak out and sell it because I'm afraid it's going to go to zero? Yes, I would sell it. In real estate, I'm just the opposite. When real estate goes up, we keep buying. When real estate goes down, I buy even more. It's like... So when you're in an asset type, I think maybe to Trevor's point, rather than saying like, oh, I don't like this asset type, let's move to something different. The idea is if condo conversion was your business model and you were convicted and that's where you were going to make your money, when the market dropped 15%, rather than pivoting your business to get out of that, if that really was your lane, you would have pivoted to double down on condo conversion, right?
Yeah, and it's... understanding what I do, I didn't even get out of it. I just changed how I acquired it. Instead of acquiring based on metrics to sell, I acquired it based on metrics to
buy.
rent.
See, but I don't understand what you do because you're doing so many things. Like you're talking about the fund, the syndication, the condo conversions, flipping houses, running developments, running property management, running brokerage. Like it seems to me like it is really hard. Like you're just straining yourself with all that.
What's the difference between him and me?
I think you are too. You have a better delegation factor of that, I believe, and you're not like you've acquired.
I would challenge the shit out of that.
His delegation?
No, like he may have more employees and he may have way more leverage, but he has significantly more responsibility. And so maybe he has leverage in a way that you see that he has, but dude, look at my lifestyle. I don't have a lot of fucking responsibility from day to day. I have a significant amount of responsibility and I have a role that I have to fill, but very few people rely on me.
So right now you're struggling, right? Compared to the past or whatnot? Like
the only reason I'm struggling right now is because I'm 2 years out of buying a business partner out in the middle of a recession and 8 years into a divorce. It has nothing to do with what my real estate business
Your personal
is doing.
cycle.
Exactly. It's my personal cycle is fucked compared to my business cycle. And the business cycle is partly influenced by decisions that were made in a partnership that no longer feed where my business is at.
So your business is getting ready to move into the first inning, but your life isn't still in the 11th or 12th
Dude, it is
inning.
I'm telling you, talk about a bipolar world. I am in the middle of it. But what happens in the personal world absolutely influences the decisions that I'm making as well. Like that's where what I'm trying to say from an economic standpoint is you're trying to overlay the individual into a cycle. And what I'm saying is we are in them, they exist. We want to identify the cycle and how we fit into it.
So where are we at right now?
Lots of different places.
We're nationally they would say we're not going to go into a recession. Paul always taught me that when they say there's not going to be a recession, that's when we're going to have a recession. So are we moving towards a recession, or are we moving back into the first inning where it's go grab everything?
And that's where it's really hard because like Q3 just came out where we had record level spending, record level government spending, record level government income, record level deficit. So that just feeds an expansion.
Because the more deficit we have, the more money they got to print.
It's going into
so our assets are going to go up in value.
But the more money
Eventually.
that you print, but because we're teetering on inflation, which we were never teetering on inflation, so we could print and assets would go up. Now we can't print and say assets will go up because if we print, we fuck up interest rates. And if we fuck up interest rates, our values need to come back down. And that's the byproduct of too many dollars fighting for return. So we still have to get to this point where we can print without messing up interest rates. And so that's why we've stepped down and stepped down and stepped down, and where we're not printing now, but we're not letting it run on.
Hitting a more neutral.
Yeah. In my economic update presentation, I showed a bunch of graphs and we talked about the Trump trade. And the comment I came up with is the Trump run up. And so if you look essentially from COVID day or tariff day, everything since then has been like
April 1, April 2.
April 1, we had this big V, right? Big crash and then a recovery. And then everything's gone up in value the past 6 months and then kind of come down the past 2 to 4 weeks in value. And so I coined that the Trump run up, which is we were already in this long business expansion. There was a Trump trade because we thought he was going to become presidency. He did become presidency. We've had this now expansion of the expansion, which is the Trump run up. And now gold's going down. Money's being sucked out of gold, right? So money was being stored in gold, stored in crypto, stored in the stock market.
I thought they just announced it hit an all-time high today or a couple days ago.
It was going down just recently. It was going down.
It was going down, but something happened and it made it go up. I don't understand gold either. 42.53.
Yeah, so
today.
The past 2 to 4 weeks, the bet has been going away from definitely a Fed cut to, we don't think there's going to be a Fed cut, to this past week back to a Fed cut.
85% bet that they're going to cut.
Yeah, we started like after the last cut, we started at like 95%. We went down to 75%. We're back up to 85%. And so that shows up in the stock market because if they do cut, that's a printing effect. That's a release of money effect that then goes into assets. that's an interest rate. That's a cost of money effect. It's not a printing effect.
But you're saying they're not going to let these mortgages run off, or mortgage-backed securities run off of their balance sheet anymore?
No, they are. When they get paid, any principal reduction from mortgages will go into American debt bonds.
So they're going to start buying again?
Yeah, they're no longer running off their balance sheet, but their balance sheet, they get paid back in American payoff and mortgage payoff. And so what they've been doing is allowing both of those to run off. So now what they're saying is they're allowing mortgages to run off. They're not going to reinvest anything in mortgages, but what they get paid off in mortgages will go into American debt. So in effect, they're adding demand to the bond auctions, which is why we've seen yields come down, which is why, to Trevor's point, why we haven't locked our rate on a $4.2 million loan. So we could have locked, if we were scared, we would have locked at like 5.8, 5.85 if we were just threatened. But because we understand that we had Q4 supply announcements made on what's going to be added to the bonds from an auction standpoint, which just affects yields, which affects our mortgage rates. And we understand that starting December 1, they're no longer going to allow their balance sheet. So we don't have a significant increase in supply. We know we're going to have an increase in demand. That is downward pressure on bond yields all day long. So you don't be afraid of the interest rates going up. You wait for the time to play out.
I think that's dangerous.
I mean, we're talking about a few $1,000s, $3,000 a year. It's not a big deal.
This reminds me of a story Paul told me. Beef just hit an all-time high, and they had a bunch of cows they were going to sell. And the cowboys said, all right, we're going to sell them. We're at an all-time high. And Paul said, don't sell them. Sell them next week. Let's see if it goes up a little more.
Yeah.
Well, and the DOJ came in, and there's only 4 meat packers apparently in the country, and one of the 4, the DOJ came in and shut them down, which to me would raise beef prices, but the prices fell out the bottom of beef. So now they say, no, don't sell. Now we got to wait. So this just goes back to my point is like, are we smart enough to time the market? Do we know who's pulling the strings and what causes these prices to go up and down? I don't know how to understand it, but if we could understand it, to Trevor's point, we'd have a lot more money.
And here's what I'd say is the fallacy that a free market exists. There's no free market in the world. There's not one industry that has a free market. And the only way that you can try and figure out is to watch spending. That is the only way to figure it out.
Follow the money.
Follow the money.
Trevor, you okay, buddy?
No.
You're chewing some energy gum over there. He's not okay.
Not okay.
And
I just think it's dangerous to think you know. Because the more I learn, the dumber I realize I am, and the littler I understand.
So wise for 29-year-old.
It's not about dangerous to think you know. It's about understanding what you have to work with and making decisions based in vacuum. So here's an example.
That's fair.
On Friday, Caleb and I were like, dude, our yield, we could lock in now at the best rate we could have got since we got that loan commitment. But it was also the 27th, 28th of the month. It cost $43,000 to lock a loan.
To me, the risk you run... So yes,
can I
you could
finish it?
Okay, go ahead.
Okay, so to me, and again, this is a great support for what you're saying, which is I'm too spread out, which is just a byproduct of what it is. I need to have liquidity to go get loans. I'm trying to get a lot of loans right now. And so if I go write a check on the last day of the month for $45,000 and reduce my liquidity by 25%, that affects my borrowability, which affects my business. But if I can wait till Monday on the first of the month, now it doesn't affect my liquidity. Now it doesn't affect my ability to borrow. And then on Friday, then when we see some we see some more reports come out and we see what happens to yields. And then we now see that the bet is that there is going to be a Fed cut. Now the pressure to lock is off on Monday, and we can kind of see what happens on Monday. At the end of the day, we're playing with banks' money right now because we're banking on a lot higher interest rate. So I'm not making the decision on what's the lowest cost. I'm making the decision on, as trying to operate a business, what's the best use of what I have.
Yeah, and the risk is by protecting your $45,000 that rates suddenly jump a half a point in 2 weeks and you can't lock and you cost yourself more than $45,000 over the course of your loan.
There you go. And based on my knowledge, I thought that list was really low. And what I think you're not understanding is we're not saying this is 100% sure. We're making bets based on probabilities.
Sure.
And that is like the most important thing is we're trying to rate probability.
I just think the representation of how well you think you can do it is wrong.
Yeah, I'm a fucking arrogant dude that boasts on this shit.
He's Macro Mike.
All right, we're in agreement then.
I've gotten
I'm glad you agree with me.
a lot of my significance in life has been since 2012 when I started doing economic presentations. It's probably one area where I've influenced people's lives the most.
All right.
With the least value.
Well, hopefully we influenced our listeners' lives today. They've learned about cycles, and Mike knows where we're at in the cycle, but I don't.
My advice would be, if the rate works for you, lock it.
You look at a deal on a deal-by-deal basis. Mm-hmm. You're not looking at national levels where the economy's going, political pressures.
Well, and that's a really good point, is economic principles and theories are based on vacuums. That's how you teach, is you teach on a vacuum that in this perfect vacuum, this is how this principle and this theory acts. But we don't have free markets. And what you have to understand is, well, how does this vacuum being affected by that vacuum? And with that vacuum acting that way, then it puts this other pressure on this vacuum, and seeing all those different influences. And it's those influences that change the probability rating.
But there's so many variables, and if you improperly measure it.
There really are not a lot of variables.
Really, I think it just comes down to, like you said before, follow the money. You figure out who's pulling the strings. There's only 4 or 5 groups that are the biggest asset holders in the world. If you just follow what they're doing, you know exactly where the chips are going to land, because they're the ones driving those markets. When they say it's the first inning, it's the first inning.
What's Blackstone doing right now?
They're calling this the top of the first inning.
Yeah. There's a social media person I love so Ian Carroll, he just looks at spending. So he did this really good video of a BlackRock day. It's like, I just woke up and he talks about, I woke up and I took a shower, and they own this water company, and they own my toothbrush, and they own my toothpaste, and they own my soap, and they own my shampoo, and my cereal, and my bath towel, and my clothes, and my shoes, and my car, and my job. And it's just like his whole entire life is engulfed by what BlackRock controls.
It's a lot.
And we all are like that.
That's why we don't have a free market.
We don't have a free market.
We might have had it at one point, but it allowed somebody to get so big they could control the market.
Oh, that's the Industrial Revolution. We can make that episode number 2.
I better take some of that caffeine gum over there. All right, we're going to wrap this one up, guys. Deal Junkies, we love you. Please, if you like this podcast, share it with your best friend that needs to know more about market cycles, and Trevor saying you can't predict market cycles. You want to say something else?
No, we got to end this.
I just see that look on your face. All right, guys. Thanks for listening. We'll see you next time.